My job here is to at least open up your mind and consider that that equity locked up in your home could be used for something else. You have a massive opportunity here with this many people, with these kind of resources and this kind of thinking and that kind of opportunity floating around in the world right now.
I get the demand, I get the amount of people that want to buy, but at what price can they buy? That's the thing that we're missing.
That's what being so focused on interest rate does to you. It gets you into an engine for the banks to keep collecting on you. When it's their money, they can do whatever they want with it. So if you're stockpiling capital right now in the banks, that's a pretty worrisome thing. We literally have a bank sitting here in front of us that we can do these things on our own. It's now we got to figure out how to do it.
Welcome back, everybody, to another week, another wealth webinar, joined here with the whole crew, including the Lazy Cash, always here. And you know, it's kind of neat that we've got Lazy Cash who showed up front row for today's training, because that's what we're talking about. Lazy Cash. All of you that are on here that, you know, right now, if you own a house, I got some good news for you. Your house has gone up in value. I don't know how much it's gone up, depending on where you live in the country, but the fact of the matter is, if you own a house and you've had it for a couple of years, chances are your house is worth more than what you paid for it and more than what you owe, which means the good news is you got some equity. You got some money sitting there being lazy, just like my kitty cat. So let's talk about that lazy money. And that's exactly what my guest today, Aaron Chapman, is going to do, because Aaron is an expert. So Security National Mortgage Company is the name of his company. That's really not the important thing. Aaron's got so much experience in this field, and what he's going to do, and what I've never seen anybody do before ever in this space, is dissect the numbers. You know, we always look at mortgages and we look at mortgage rates. You know, today you're over 7%. 2 years ago, you were 3% or maybe even under for some of you. And, you know, we're so caught up and focused on the rate. And right now, because rates are so high, it's really driving demand, because people aren't selling their houses because they've got all this equity locked up in their house. They don't want to sell it because then they got to move into another house that they're going to pay a boatload of money because it's at the top of the market. Plus, their interest rate's going to more than double in some cases. So they're just saying, you know what? I'm just going to stay put. And I get it. I really do. But what is the math behind that? What is the after inflation adjustments? Like, what does that mean after we take out inflation? Like, how much are you really paying for your house at today's interest rates if you decided to either move to another house, sell your house, or I think one of the things that we talk about, probably not enough, but we do talk about it, is refinancing your house to pull that equity out. Now, when I say that, doesn't that make all of you kind of just say, oh, no way? I wouldn't refinance my house right now to pull the equity out, because my rate would go from, let's just hypothetically say 3 to 7. That would never make any sense. Well, let me ask you the question. Have you ever actually run the numbers to see if it makes sense? People lie, right? We all know people lie. My cat sometimes tells me lies too. He's purring and I'm petting him and he's telling me with his purr, he's not going to bite me. And then all of a sudden the son of a pup bites me. Like, people and cats lie, but math does not lie. And I think what Aaron does better than anyone I've ever seen is show the math behind it. Because if you've got equity wrapped up in your house, if you've got that lazy money sitting on your couch, eating your potato chips, drinking your soda, while watching your TV, while you are out working trading hours for dollars, the one biggest thing we got to look at is, what is the value of that money trapped in your 2x4s? Why is that money lazy? What are the reasons you're not tapping into that? Is it because rates are high? Because I guarantee that's the majority of you. When you look at the rates, you're like, oh, I don't want to, hey, you're in the way. I don't want to get a home equity line of credit and use it because it's 8%. I don't want to refinance my house and pull cash out because I'm going to go from 3 to 7. Those are some of the reasons. But how much could that hidden equity, that lazy cash, be out there making you that you don't have to work any harder, any longer, or take on any more risk for? Secondarily, does it make more sense to do just a regular home equity line of credit, or does it make more sense to cash out refi? Let's look at both of those. And to put a pretty little bow on this whole thing, Aaron, what makes him a unique unicorn, if you will, is the fact that he uses the infinite banking concept, has for a long time, is a total proponent of the infinite banking concept. So he understands what we talk about every single day, whether it's Stephen doing the presentations or me doing the presentations or anyone else that's talking about infinite banking. Aaron understands all that. And Aaron understands how to use the equity and the infinite banking concept to get you further in your financial, wherever you want to be, your financial journey, and how to do it more efficiently. So Aaron, welcome to the show.
That's a hell of a lot of intro, brother. Thanks, man. I appreciate you guys letting me on and letting me participate in what you got going on here. You got a really, really good crowd showing up. This is cool.
Absolutely. Hey, the script was written by Lazy Cashier, so don't give me any credit.
Right on. So a little quick little chat GBT on Aaron Chapman, and then you got it all figured out.
I guess that's what he did.
As you gave me you kind of gave the rundown on my experience when it comes to financing real estate. Let's take it all the way back. I started in 1997. My focus has been real estate investors since 2003. And there is about 1.1 million people in the United States that do the job that I do. I didn't know this till I got contacted by a third-party source who tracks all the transactions. When they were tracking this, they're looking at who's doing what. And when they contacted me is because I was ranked #1 in my state and #7 in the United States for transactions closed for 2022. Now, looking at that, to me, that was a big, I don't really pay attention to it. It's a really big deal to consider. I focus on the real estate investor. That's where the majority of the deals I do. Don't do a lot of business in my own state. I focus on all the places where real estate investors are buying, the South and the Midwest. And I was ranked #1 in my state, #7 in the United States. Well, the reason I bring that up is not to beat my chest. It's because you guys, if you're looking at getting financing on real estate, you can have the opportunity to talk to a lot of different people, over 1 million different people that do this job. Now, there's this old saying that I heard years ago, it's good judgment comes from experience and experience comes from bad judgment. The problem with that is you can learn really well, but it can be very, very costly. It's a good way to learn in the grade school playground, not in real estate. So what we want to do is be able to give you a little bit of an idea on how some of these things work, because there's a lot of trapped up equity today. And a lot of that equity was created because of the low interest rates. Now, the low interest rates that we'd had were all because of the quantitative easing that was done by the federal government back in 2009. It was announced in 2008. The second they announced it, money started pouring into the mortgage-backed securities, inflating the amount of capital to lend, bringing the interest rates down. And they've stayed down all the way up until the announcement of quantitative tightening, which was October of 2021. That's when everything fell off a cliff. The interest rates spiked. They've gone up over 3 times what they were at their lowest point. If you look today, in fact, it was yesterday, I haven't looked today, the bankrate.com was showing 7.53 as the average interest rate for the average home owner, not your investor. So interest rates have gone up significantly. So to the point that Chris was talking about, I know it seems counterintuitive to want to refinance at a time like now. If you're getting interest rates in the 2s and the 3s, and now you're seeing an interest rate in the 7s, even if it was in the high 6s, that's still a lot higher. And many people will worry about, why would I do that? I would only advocate to do that to pull cash back out, and to pull cash out and determine where you're planning on putting that cash, not to use it to buy a boat, not to use it to get more toys or just spend, is to reinvest somewhere. And as Chris had indicated, I am a big proponent of the infinite banking strategy myself. Give you a little bit of history on how I got into that. 2008 came around. I don't know how many on here, was involved in investment real estate, or what your financial situation may have been in 2008. But I was doing what I do now. I had multiple different properties across Arizona. My net worth on paper is about $3.5 to $4 million. I was 190 pounds. I was a marathoner, and I was a rock climber. I was headed out of town on August 8th of 2008 on a Harley to go clear my head for a 3-day weekend of riding. And 15 minutes into that ride, I got taken out at about 80 miles an hour by a kid driving his dad's truck. I woke up that night, basically not knowing where I was at, just looking at the fluorescent lights above me. I just had surgery. I lost the use of my legs, the use of my right arm, and my mind was resetting every 3 minutes. By the time I got out of the hospital, I went from that, nearly $3 or $4 million net worth to a negative net worth of 1.5 million. Everything was vaporized. My credit score went from the 800s down to 460. I was in a wheelchair. Now, I went from 190 pounds to 156 pounds. So I had to start crawling back from all of this stuff. So going from 2009 to 2016, I'd gotten back to a 700 plus credit score, got everything paid off, got myself into a positive position, barely positive. At $90,000 net worth is where I was at. I had 90 grand sitting ready to go invest. And that's when I heard about the infinite banking strategy. When I'd heard about that infinite banking strategy, I thought it was nuts. I called the person who I'd heard was doing it and said, "Are you freaking stupid?" Life insurance is one of the biggest scams I'd ever invested in my life, as I got screwed on 2 life insurance policies. Well, when I sat down and ran the numbers, it was over my birthday weekend of 2016. And I immediately, once I understood this, took the $90,000, moved it into a life insurance policy with a $2.7 million death benefit. And at that time, I was able to draw just a little over 80,000 against that policy to buy the investment properties I was intending to anyway. I purchased those properties, took the cash flow from those properties, plus 10% of my income, which is what I used to save the 90 grand to begin with, started paying down the loan against the policy. Within about 15 to 16 months, I knocked it down enough to buy another property, increased the cash that was coming in every month. Plus, I was making more money, kept paying it down faster and faster and faster. Since 2016, I've deployed $1.1 million, a little over $1.1 million out of that policy into multiple different investments. I've now structured a business where my family, they all have to have policies when they get married, them and their spouse, because if something happens to their spouse, they ain't coming back to live with me. They all have to vote on what we do as a family. We use infinite banking as the foundation for all our capital, goes into multiple different policies. Like we have 7 now as a family, not including the policies outside of the family between the spouses. And that's where we structure it. So just to let you know that I am a big, big, big fan of this. Now, when it comes to your current equity, as we had said earlier, equity was built because people were willing to pay way more than property value at the time they're bidding on these houses because the affordability. And what's crazy is people are freaking out about the interest rates right now, but not a lot of people were bitching back when interest rates were 2 to 3%. And the realtor says, "Hey, you got to bring another 50 grand to the table just to get in the game." You are pretty much losing a lot of what you're getting with the extra 50 you're paying for the house anyway. It's amazing how people don't think about that. You're literally cutting into future equity. But because of those bid ups, we pushed these property values up very, very, very high. Now we're able to look at that as a potential opportunity. If you can refinance, pull cash out, expand your infinite banking, that is a solid opportunity. But let's talk about something. People talk about the time value of money. Some don't quite understand what that means. What ends up happening with inflation is our dollar is losing a significant amount of its value. And the best way to explain this, I've heard it told to me that back in the, and you can look this up, back in the early 1900s, they used to mint a $20 gold piece. You could walk into a department store, get a hand-tailored suit, a shirt, a tie, a belt, a pair of socks, and a pair of shoes for that $20 gold piece. Now today, 2023, you can't walk into a store and get a hand-tailored suit, a shirt, a belt, a pair of shoes, and a pair of socks for 20 bucks, but you can for an ounce of gold. Now, I know this because I had some suits recently tailored. I go back and forth to DC. I meet with members of the Senate and Congress about housing and low-income housing and affordable housing and how to help investors on a regular basis. So I have to now dress one of those damn things. So when I had that done, literally for 2 ounces of gold, I was able to get 2 suits made and get all those things that I just talked about. So it's not that the gold became worth more. It's not that the material for the suits became worth more or the labor. It's that what we exchanged for the gold and for the suits had become worth significantly less. Another example, 22 years old, I could go into a Taco Bell drive-thru. I could get 2 bean burritos and 2 tacos and a drink for $1.99. It was on their value menu. My daughter, a couple of months ago, on her way back to school for one of her practice for something that she's doing after school, there was a Taco Bell. She says, "Go through there." I haven't eaten that crap in a long time, but she ordered exactly that. 2 bean burritos, 2 tacos, and a drink, and it was 15 bucks. So again, that shows what's happening to the instrument we're exchanging for goods and services. So looking at that, consider this. If you lock in your loan right now and you purchase a property and you get a 30-year fixed, does the lender get to adjust the payment on that loan because of inflation? They do not. They have to accept the exact same dollar amount every single month for the full 360 months. I'm going to pause right here. I'm going to put something in the chat that I need everybody to get. So you need to go to your app store. As you're going to your app store, I'm going to put in here what you need to look up. You need to get this, the QJO investment tool. So look that up. You're gonna, when it pulls up, there's gonna be the top one, that's a paid one. You go down one, you will see the QJO investment tool. It's a black screen on the app there. It stands for the Quit Jerking Off investment tool. I had this tool made. I had this app made. The reason I had this done is because people are wasting a lot of time and energy on things of zero value, which is chasing around an interest rate. Then in reality, you're not getting anything out of it anyway. All it is a way to get you, the consumer, to get wrapped up and caught up in what the bankers want you to do is to be focused on rate. So while this is all downloading you, let me tell you something here. So yes, Todd, the Quit Jerking Off investment tool, because that's what people are doing, searching for rates, just spending time to things of no value. Let me explain here what I mean about the banks literally putting you into slavery when interest rate becomes the main focus of what you're doing. When you're chasing around running for rate and you think that that's what you need to be getting, you get caught up in the narrative that they start to give you later on, is that every time the rates drop a certain amount, you should just refinance. A lot of people do that. That's a regular thing that they do. Well, who has looked at a 30-year fixed amortization table on a loan? You'll find the first 5 years, there it is. Chris has got it right there. You'll find that the first 5 years is almost all interest. It's a significant amount of it goes to interest. Now, let me tell you a story about a client of mine. They had a 30-year fixed loan. They paid on for 47 months. And then they come to me and they want to do a refinance on this house. It's a $120,000 loan. I asked them, how much cash do you want to get out? He goes, none. I'm like, that's crazy for you to do a refinance without cash out. He goes, no, I've been told that once the rates go down a certain amount, you always refinance. That's what I've always done. My dad did it. I couldn't convince him otherwise. Well, by month 48, we're funding this loan. Now, he had made payments all the way up to that point. His payments were about $37,000 in total payments over 48 months. But the balance on the loan had only dropped about $6,200 to $6,300. Paid $37,000, but only paid about $6,200 down on the balance. When we refinanced the house, the loan costs and everything stacked up to bring the new loan amount within $102 of his original loan amount 48 months earlier. And he was happy with this because of the lower payment. What he had done, he said paid nearly $37 or a little over $37,000 in payments, but ended up in the exact same place he started within $102 of where he started 4 years before. Now, I tried to stop him. I could close it and make money, but I wasn't about the money. It's about what his practice was doing, because this was a real estate investor. I need to keep him going at what he was doing. But if he continued this practice for the next 20 years, he would have paid over $180,000 in payments on this house, but still had the exact same loan amount. That's what being so focused on interest rate does to you. It gets you into an engine for the banks to keep collecting on you. Now let's go back to your app. You've got everybody's got the QJO investment tool up, I hope. I need to have it up actually. And let's go to the third calculator on here, which is the mortgage amortization schedule. So this way people are familiar with how to use it, and it makes it easier to use once you understand it. So the third calculator, mortgage amortization schedule. Now you're going to put, this is for a purchase when you're analyzing a purchase. You're going to say 20% down. So put 20 in there in the first line. And let's say it's a $200,000 purchase price. Make sure you get those zeros in there, right? Because if you don't have a comma, it throws you off a bit. And let's just go with 7.5 for the annual rate. So type in your 7.5, ignore the additional payment. That's if you're in that mode that you want to throw an extra $100 at it, see what it does. I'm going to tell you, don't do that. Don't pay it off any faster than those some bitches want to accept the payments. So hit your calculate button, and you're going to find your principal and interest, well, your principal, then your interest, then the total payment. And then the inflation adjusted payment, ignore that from now, and then your current loan balance. So as you start out with a $160,000 loan, after the first payment, you're going to have a little bit drop in the balance. Now in the upper right-hand corner, it looks like a calendar icon. Click on that. It's going to highlight 2023. You're going to want to scroll to the right. Let's do this, scroll all the way till you hit 2053 when that's highlighted, and then hit save and close. As you scroll to the bottom, you'll find that over 30 years, you will pay $402,747.56 on this loan, $160,000 loan, $402,746.56 over 30 years. But every time the dollar leaves your hands, it's worth a little bit less. So if you go to, I always go to a place called Shadow Stats to look and see what's going on with inflation. Inflation, you look at the true rate of inflation, not the CPI. The CPI is they're only measuring certain things and mostly measuring things they can manipulate with monetary policy. You look at the true rate of inflation, it's been above 8% since the 80s. So utilizing 8% as our baseline, we're going to see inflation adjusted payments of $152,466.23. So ultimately, you're paying back less than what you borrowed. That's why they want to keep you thinking about refinances. That's why they keep saying if the rates go down a certain amount, you get it, go get it again. They don't want you paying it for 30 years. Even if it was not as high, let's say that the inflation was only about like say 6%, you will find that you're still paying a lot less in interest than what you're really paying because you're paying it back with the deflating instrument like the US dollar. So that is one thing that you can use as a way, at least just understanding when you're getting into this whole scenario and you're thinking about pulling cash. I pulled cash out of my house and put it into another policy. I've got 7 of them total because it's declining here while it's inclining over there. And I can use it to do more things. I invest it in multiple different things and continue to keep growing it. What you choose to do with this whole different, that's up to you. That's between you and Chris and other investment opportunities. My job here is to at least open up your mind and consider that equity locked up in your home could be used for something else. And then even when you're paying a higher interest, you're not paying a higher interest. If you're a real estate investor, this is key to get your head wrapped around this particular thought process. I get it with your home. I mean, it's kind of hard for a person to say, I want to refinance my 2.5% interest rate for now a 7% rate. I get it. It's hard to do that. If you have investment properties, things are going up as far as your interest rates, property prices are going up a little bit. Anytime you can get a third party to pay the mortgage for you, even if you're not making a single dollar of cash flow, you are continuing to expand what you're holding. You keep expanding your portfolio, keep expanding your assets. And one of the ways I do that is with the infinite banking strategy. Put all the capital I can into my life insurance, and then I use it, borrow against it to buy more real estate, invest in more opportunities. So one of the things I wanted to share with you guys, because I know that right now many people are thinking, what's going to happen with the interest rates? I'm going to give you guys the breakdown here that our interest rates are going to do nothing but go up. And let me explain why. Now, this particular screen is not going to make a lot of sense to everybody. But what this is the mortgage-backed securities starting way back in 2008, right back here. I can't see on this particular screen where it starts at. Let me see here. So right back here, the very first date that I can get to pop up on here is about September 8th of 2008. If you get to this point right here, it was November 25th of 2008. It says on the screen November 24th because this is condensed. November 25th of 2008 is when the Fed announced quantitative easing. You guys familiar with that term? Chris, you're probably familiar with it. The quantitative easing was when the Fed decided they were going to start putting capital into the markets to bring interest rates down. If you've ever seen the movie The Big Short, they talk about the mortgage-backed security, or MBS, how that got all started. Well, the federal government took public capital and started throwing into these pools to bring the rates down. What I have drawn here, this yellow line I drew, was marking the price point of this security, the value of the security, the day the Fed announced quantitative easing, meaning the Fed was going to start dumping capital in. The day they announced it, a lot of other entities started shoving money into this, and they have continued to drive capital into it all the way up until this point, which was the end of October 2021, or middle October. So everything here above this was what drove our interest rates where they were. That was all public capital. Then when the Fed announced that they were doing what they call quantitative tightening, you can see that everything fell off a cliff, interest rates spiked up, and now we're in this area. Now, this line again, I've drawn here to show, as you can see all the way over here, the yellow line references the price point from 2008 prior to the Fed putting that capital in. Now, as we see here, here's that yellow line. It has become a barrier and a ceiling, meaning there's no value in it in this particular instrument for anybody else other than a federal government to throw capital in here, because they're not going to make a very good return on investment. That, I believe, is going to be the best we're going to see for a very long time. And I've drawn what we show as a trading channel, because all this is, it's an instrument. It's basically like people talk about the 10-year treasury or the bonds as a way to track interest rates. It doesn't really correlate. It's another long-term bond. That's the only reason people look at it. Bonds are going to attract people on investment on some days. Stocks will attract investment on other days. Typically, bonds do better when stocks do worse. In this scenario, this is a long-term bond, so it will attract investors in around the same time that the treasuries do. So because of that, we're watching, this shows you what the traders are doing on a day-to-day basis. I've drawn this channel to show that they're trading within this channel. And this is basically where the value is. So they will sell off when it gets to this point, start buying it when it gets to this other point, and they start trading in this downward channel. The more it goes downward, the higher the interest rates go. As I've drawn it, if you watch my YouTube channel, you'll see it for the last few days. I've been telling everybody we're outside the channel, but if we follow the history of it, we're going to get back in within the next few days. Today, we got right back in the channel exactly as I predicted. Traders are very predictable unless there's massive influence to push it one way or the other. The massive influence was the lack of capital going in by the Fed. So we are going to continue to trade downward, and I believe we're going to go into this particular area before we settle into it and start moving sideways, potentially. And that is going to mean our interest rates are going to be somewhere in the range, I believe, of 7.5% to 8% for the coming future. If you look back in history, when I got into the industry from 1997, it was 2000 to 2008, our average interest rate was 6.4% per Freddie Mac. And I'm going to share this screen with you real quick here, just so you can see what interest rates have done over the years. Averaging the 30-year fixed rate since 1971 to today is actually till it was June of this year, 7.74%. It's the average interest rate over that period of time. Now, take out quantitative easing, which I just showed you the charts of all that money, $8.9 trillion from the Fed going into there. You take that out, the average interest rate from 1971 to 2009, when the Fed started quantitative easing, was 9.12%. And that's a 30-year fix for your average homeowner. What I'm seeing from 2000 to 2008, the average interest rate for the average homeowner was 6.48%. Today, we're over 7%. So I think that we're going to continue to see interest rates in this range, probably a little bit higher for the near future. Some people claim that rates are going to come down in the next couple of years. Here's my question to them, and a question you need to have in the back of your mind. Come down from where? Because they're going up right now. They're going to keep going up till they find that point where they don't need to go up any further and more capital is going to come back in. There's got to be a risk level in here that's going to draw more investor capital. Now, who all knows the name Charlie Munger? Chris does. There's probably a handful of you that recognize that name. Now, Charlie Munger is a name you'll probably recognize more as Warren Buffett. So Charlie is Warren's business partner. He was on, I believe, CNBC or MSNBC recently, and he had indicated in the interview that we had 40 years of declining interest rates. We are going to see 40 years of increasing interest rates. So what I'm telling you now, if you are thinking about it or having a heart or just really, really seriously struggling with the idea of pulling cash out of your house, but you can see opportunity with that money, infinite banking, other things you can make money with, I'm going to say seriously consider it, because I believe that we are not going to see interest rates this low for a very long time. Even though the rate a few years ago was much lower, the rate today is much lower what it's going to be coming forward. I don't know exactly how soon we're going to see it, but we're going to see it soon. Now, I see a lot of people asking about interest rates and what inflation was the real inflation rate. I'm going to pull up shadow stats right here. I'm going to pull up shadowstats.com. I would encourage anybody, you got it, go ahead and pull it all up, because inflation, the problem with the CPI, us using the CPI is that is an index that has followed only certain things. They don't follow all of it. Go to the shadow government statistics. And what this is an economist that goes in and they start adding everything back in that the Fed does not add in. What's interesting, and you go to alternate data and go to inflation. So what we'll see here is this is tracking it all the way back from 1981, I believe it was. So they started tracking that, and you can see it, they followed pretty similar. You know, inflation was going down because what was going on with Paul Volcker and, you know, driving up rates and pushing things down. People's costs of things were going down because they weren't spending as much money. The reason you have inflation is because you have too much money chasing too few things. So think about that. Paul Volcker shoved interest rates way up to the teens with the federal fund rate, right? So people had the inability to spend money as they did prior. So less money chasing actually more goods at the time pushed inflation way down. Then we start to see how things continue to grow. Now, the Fed, they started adapting what they were going to track. They also had a substitution process. You can look this up. If they were looking at, you know, a person that was eating steak all the time, for their meals, but they could still sustain themselves on say chicken. They would substitute for what's the price of chicken. Well, now wait a minute. Well, chicken's too expensive. Let's substitute for ground beef. They would continue. There was a substitution process that they were using to maintain their lifestyle. They don't track the exact lifestyle, but if you follow a person's precise lifestyle going forward, that's where this blue line kicks in. That John Williams shows the shadow stats, which are our current inflation are about 13%. Well, if you're looking at the history of inflation, we're pushing just a little over 8% quite consistently, except for a small window of time in the late 80s, mid to late 80s. So that's where we're coming from with our 8% inflation as a real cost of living, and that's actually a very, very low estimate compared to what's really happened with inflation. Quick question here. I'm not sure if anybody knows this, but maybe Chris does. Where did the 2% inflation metric even come from, the target? You know where they even showed up into the mix?
I have no idea, because the average inflation is usually around 3 to 3.2. So 2 was just I feel like a number that the Fed pulled out of thin air.
Exactly where it came from, actually. So in 1996, there's an open market committee meeting when you actually had Greenspan in there, and Janet Yellen was in this meeting, and it was asked of Greenspan what would be the target for inflation for the U.S. economy. He said that if we could keep it at 0, that'd be the best. He goes, but we really even don't have a accurate way of measuring inflation, and this is in the transcripts of that meeting. I have them. I can send them to you. Well, it was suggested by Janet Yellen that since they did not have a real accurate way of tracking inflation, why don't they just go with 2% to give them some slush? It was voted on by everybody in there to go with 2%. And at the end of this meeting is, I think, page 115, if I remember correctly, and I'll shoot you the transcripts. Greenspan said, we got to keep this information here. We can't let this out because this will cause us more problems than it will ever solve. And to let people know that we were talking about this 2% thing. So very interesting. They just pulled it out of thin air. Exactly what you said. Now, I see a lot of people talking about HELOCs. HELOCs is definitely a valuable tool if you have a way to pay it back quickly or continue to pay it back. If you're going to use your HELOC to invest it somewhere or put it to work somewhere, make sure you're putting it back. Too often, people use the HELOC and leave it out there, and they get severely screwed by it because you are going to continue to move with the market. They are going to collect every bit of interest from you. You're not going to take advantage of a set cost that's going to be influenced by the time value of money. The time value of money will work with the HELOC to the extent that you will be paying all of that interest and that return back. But if you have the ability to take it, put it to use, put it back, take it to use, put it back, it can actually benefit you, and you have that useful tool. But when the market freaks out, they freeze HELOCs. Wells Fargo just stopped doing HELOCs all of a sudden recently. I've been told. I have not confirmed it for myself, but that's what I was told by one of the people who had a Wells Fargo account. During the crash of 2008, I don't know if you guys have ever heard of the all-in-one loan. A lot of people are using that now, where you finance your house with basically a first lien HELOC. Your check goes into it as far as your income goes in it, and then you use that to pay your bills, and it pays down your house faster, and then you have access to that money. That was a big thing in the early 2000s. They shut that down right as things started to move, as far as the economy did, and things started to get shaky with 2008. They saw the pattern where people were depositing their income and taking out to pay their bills. They would wait till the payments went in for their income, and they cut it off. And people had no access to their capital whatsoever, and they were frozen up. I got hundreds of calls because I was with Countrywide at the time, and I was the biggest seller of credit lines that Countrywide had. And it screwed everybody over, and they were pissed at me. I didn't think that they would do that. I didn't know that they would do that. But the banking industry can do whatever the hell they want when it's their money. You always got to remember that too. When it's their money, they can do whatever they want with it. So if you're stockpiling capital right now in the banks, that's a pretty worrisome thing. I just got done moving a significant amount of money right back into another life insurance, right back into my infinite banking stockpile, I guess we want to call it, into my cash value. I liquidated a few things and put a couple $100,000 back in there because I'm just not trusting the banks to hang on to that money at all.
Well, I think you were hitting on a nerve there. With what happened, it just doesn't seem like it was all that long ago with banks failing, and then the Fed coming in and printing money or not printing money. I mean, basically creating new programs saying, oh, it's not going to hit the taxpayers, and then, bailing the banks out. I think that was a big sham too, because they're saying that, that money's not going to be, they're not going to bail those banks out with taxpayer dollars. But what they're going to do is charge all banks higher insurance, which means all banks are going to charge us higher fees. It's already happening. They're going to lend, differently. Okay, so a lot of the community banks, especially the one I deal with, have completely changed their lending criteria, making it very difficult to get loans, making it almost impossible to get loans for flips, making it almost impossible to refinance, and do the BRRRR strategy where it actually made sense, because they've changed all their percentages. And I asked my guy, and he's a friend. I mean, I've known him forever. And I said, what's going on? He said exactly that. He said, when all the banks get bailed out, the government comes to every bank and basically puts all that load on us with higher insurance premiums for what we have to basically carry. And they change all of the limits and the rules and everything, which makes it harder for us to do business the way that we used to. So I'm sorry, what we used to do will never be done at this bank again. We just got to follow what they tell us to do. So they're marching, all the banks are marching to the same master, if you will. And a lot of people don't realize that. So I don't care if you've got a great community bank, a good commercial bank, like what I'm seeing is they're all going to put the hammer down on us.
Oh, I think it's going to get quite out of hand, how this all working. So the more capital you have stored in the bank, the more you're at risk. Putting it into an infinite banking strategy, or really in any instrument, I think, other than this, hard assets and this. I was seeing people talking about getting older vehicles. I got a buddy of mine that owns multiple companies. He buys a new Ford truck every so many years. I just buy from him. So when he's done, he takes care of it. He is the most meticulous son of a bitch I've ever met in my life when it comes to taking care of his vehicles. I've bought 3 from him. 3 years old. It's got maybe 100,000 miles on it because he has to drive like crazy for his job, but it's well taken care of. I pay cash, and I've got something that was less than half of what he paid for. It's a brand new truck practically. So I've got 3 rigs from him. I don't blame you. That's how I go about it. When it comes to this, it spurred a thought the way I just had there, Chris. We're borrowing from banks, especially the BRRRR strategy. I finance a lot of that. And let me tell you guys right now, there's 149 people on here. Don't ever pay cash for a house, whether it's a BRRRR or anything else when you're intending to pull money back out until you call me. Most lenders don't know how to get that money back out, and your money's locked up for a year. Get it out as fast as you can, because who knows what's going to end up happening. Now, there should be a way we should be able, and I'm seeing this right now, Todd's thinking what I'm thinking, that this group right here, 149 people here, that we can interact together and say, okay, I got this BRRRR I want to do. I need to be able to get a hard money loan on it with my group here. You put a lien against it. When I refinance a hard money loan, the loan on it is 75 to 80% of the value of the home. We get your money right back, pay off that infinite banking loan, goes right back in, right? So if people are able to collect a few more points above what they'd be getting in their infinite banking of 5% or whatever that might be, the community's making money. We're creating our own banking system. We're creating our own BRRRR financing system. And then we do the long-term financing with the banking world, make those some bitches eat it for 30 years because you're never going to pay them back anyway.
Yeah. And one thing I know a lot of people don't realize, and I think it'd be good coming from you more so than me, is a lot of people, when they're looking at private loans or hard money loans, they're looking at a higher interest rate, 12, 15%. They're like, oh, banks, we get it all the time on this show. Banks will lend a lot less. I can get a loan from a bank for 7%. And they say, why would anyone pay 15% when a bank will do it at 7%? But what people fail to realize and fail to look at is on that closing document you get from the bank, why don't you just review all the fees that you pay? And people even complain on hard money loans if you charge points. So like, oh, a bank doesn't charge me points. Oh no, they absolutely charge you points. They just don't say it's points. It's this fee and that fee and all these other things. I mean, the closing costs probably amount to, and maybe like a percentage, like all those added closing costs that a bank puts on your property when you refinance it or buy it, like what do those work out to be in a percentage,
You're probably looking at about 5 to 7%, depending upon your loan size, the way things are at today. And it's actually be even closer now. I tell people add in 10% or $10,000 on their average transaction because there's points on everything as an investor these days. Now, that's great on a 30-year fix. It's not acceptable on something that's really, really short term. So it's a matter of where do we find this hybrid of being able to work with the community like we're talking about here, create this financing. And, when you're talking about hard money, you got a lot more flexibility to create that. And then you're lending that out inside your community. They get the deals done. We come in and refinance 30 or 50, let the banking industry eat that for the next 30 years and continue to build what we're building. So I think that there's definitely some opportunity here to be something that we need to research and do some digging into.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you, privatemoneyclub.com. Back to you, Chris.
There's a way to create a system. What's interesting about this, when it comes to financing a property cash and then doing some rehab on it, what we run into in that world, in the banking world on my side of it, is that when a person pays cash flow, let's use some numbers, paid say $50,000 to acquire a property that needs some rehab. Then they, after they take ownership of it, they put $20,000 into this rehab that they pay their contractor. And now that they're done, they're ready to pull their cash back out. They've owned it for only about 3 months and the property's worth, say, $110,000. You should easily be able to get that cash back out because the loan, what you spent, is less than 75% of what the value is. But you can't, because the banking world says you have to own the house for a year. So what we do, the reason I tell everybody, call me before you start, is we encourage our folks to find out exactly what this property is going to cost you to rehab it before you close on it. And when you close with that cash purchase, you walk the full $75,000 into closing. Then title company will pay $50,000 to the seller. The seller goes away. You now own the house. The title company holds $25,000 in escrow, and they create what's called the repair escrow. And then they pay the contractor for you. Sometimes the title companies give you the money back, so you pay the contractor. We're not going to manage it. But the bottom line is, I see a settlement statement that says $75,000 was used at closing. It has to be done a specific way. If it's done wrong, it's locked up. I will guide you through that. We look at that settlement statement, the draft, before you close. We look at each one of them, look at every step. I've got a team that manages all this with you. You close properly, we start the refinance the day after you close on it, and you start your rehab. The second the rehab is done, everything's done. They got to clean up that property, they got to mow the lawn, everything, get all the tools out, get the entire mess out. We send the appraiser immediately after that, because you want them to appraise a complete home, not a mess. Appraisers, you don't want them using their imaginations. Their imaginations suck. So then what we do is we get their appraisal in. If it's what it's supposed to be, then we end up getting that refinance, and you get all your money back out. You're in the deal for nothing. You own this property, it costs you nothing because it's somebody else's money. It's the bank's money. And then when it's the bank's money putting this up, let's say it's $100,000, right? You got a $100,000 loan, and you did your job as an investor picking the right property that stays reasonably rented the entire time you own it. Who pays that back, right? It's the tenant who pays it back. That $100,000 loan, we'll take 100 and develop. Actually, I got a scenario that I can just give you guys. There's a $200,000 acquisition, $160,000 loan. If the tenant pays this $160,000 back, this guy put $40,000 down plus $10,000 in costs. He's in this thing totally for 50 grand. That $160,000 loan over 30 years, paid back by the tenant, is $5,333.34 per year. Do the math. You factor that into what you put down, the 50,000 or his investment, 50 grand. That's a 10.6% increase on his investment every single year, just having somebody else pay off the note. That's no cash flow. Now, let's say he's in an area that appreciates 2.5% per year. Just 2.5%, doesn't have to be a lot. That 2.5% on a $200,000 property is $5,000 that first year. He invested 50 grand, that's another 10%. He's making 10.6% on his money without any cash flow coming in, without any tax benefits yet. So you can see how big this can be if you're looking in the right place, working with the right people. Too often people are shopping it all around. Who's the cheapest for everything? And you end up getting what you were looked for was cheap. You don't get all this stuff. You get screwed most of the time. Go with people who understand it. I've been doing this since '97. We can guide you through every single step. You have a massive opportunity here with this many people, with these kind of resources and this kind of thinking and that kind of opportunity floating around in the world right now.
Well, I think it's huge because, with what we've got with private money, private money club, I should say, a lot of private money is going in, but we all want our money back. So if we're a lender and a private money, whether it's coming from our policies or from home equity lines or whatever it is, we want to get our money back. And sometimes the only way to get our money back is for that borrower to refinance the property if it's a rental. So a lot of times they're going to the national banks, the Bank of Americas, the Wells Fargos, and they're just getting the runaround. And especially right now, because those banks are making it really difficult to get loans. But that's what I love about what you do, is you fully understand all this stuff. I mean, doing it since '97, but you can take an investor, understand the investor side, but also understand what the banks are going to want and make the deal. And I noticed a bunch of questions came in from Will and Kat that we'll get to in a moment. And if anyone else has questions, throw them in the Q&A. But I just think, like, if any of you are looking at a property, a rental, or something that you have and you need to get money out of it, this is your connection. Like, and we'll have Aaron put the contact info up there, but you just need to get on the phone with him and his team. But Aaron, I want to also go back to one thing we were talking about earlier. Kind of, we almost started with it, lazy cash. You know, everybody's got equity in their house, and you know, there's really the two options they can do. You know, they can do a HELOC or they can do a cash out refi. Most people right now are choosing to do the HELOC. And I know we favor the HELOC a lot, or at least I did until you started showing me some of the math, because this, you know, is a second to a primary mortgage, which is probably 3%. Where over here, you're refinancing probably 7+%. I don't know where rates are today, but you know, so when I look at it, I'm falling victim to the same thing we all fall victim to. I'm just looking at numbers. I'm looking at 3 and I'm looking at 7. But then when we layer in the HELOC is going to be 8, but it doesn't affect this. But on the contrary, if we wanted to pull equity out, doing the refinance, let's just say we're going to have 7 to 10% in closing cost. Okay, our rate's going to go from 3 to 7, but let's just say we get to pull out $100,000 here, and we get to pull out $100,000 here. So it's the same dollars that we can pull out. The lazy cash, one is through a HELOC, one is through an actual total 30-year cash out refi. How would you make sense of this mathematically into which one really does make the most mathematical sense? I mean, I want to say this one, but deep down, I know because of what you've showed me with your calculators, this one does.
So the reason that, and it's difficult to do the mathematical, actually do an equation show, this is why it is better to go with the fixed versus the HELOC. The one reason that we do know it's fixed versus the HELOC, because it is fixed. You're going to pay that exact interest rate, whatever it is, for the next 30 years. And you're going to have it paid off by hopefully somebody else. Now, with the HELOC, it moves with the market. It will continue to adjust. It can actually freeze up on you. They can actually, they can do whatever they want with that. There's a lot more latitude on it. But the one thing I do know is we know interest rates are going up. They're continuing to go up. And because they're going up, you're not going to be locked at 8%. Every time you use that, if you can use it to pay it back quickly, I would say the HELOC is a better move. If you're a person that has opportunities sitting in front of you, get in, get out, get in, get out, get in, get out, HELOC is definitely the route to go. But if you're a person that has long-term capital, you can be putting it to use out there. You got somebody else who's going to be paying it back for you, especially in the rental world. That cash out refinance or that 30-year fix is always best. In the fact that I cannot predict the future and how things are going to be, and even if I'm going to take the money in and out and in and out, I would much prefer, and I've done it myself, and this is why I can say I'd much prefer to do it, because I have done it, is pull the cash out in the cash out refi, use that to expand my life insurance policies, grab another policy I can, or pay back existing loan if I've got a big loan out there, and then continue to cycle the money back and forth from there. I know what my set cost is on this 30-year fixed, and then I can put it to work with the infinite banking process and move it back and forth the same way that I would with my HELOC. I can literally get the best of both worlds. The problem with the HELOC is if I pull it out, I throw it into the infinite banking process, and I'm using it over here, it's eating me alive over here. So it's not going to do the same. I had an individual, there's kind of a case in point. And again, it's not that I have the math to show this. I just have the person to show it. This guy had contacted me because he had used HELOCs to do his down payments and do all the things that he was doing. But the problem is he kept deploying it, and the capital was sitting and growing, but not to the extent he could take it and pay back his HELOC. He had listened to other people says use HELOCs to do all these acquisitions. Well, things started to grow as far as the payments on these HELOCs started to compound to the point that he couldn't afford them anymore. He went from having a surplus of about $1,800 a month to pay bills above and beyond the actual bills to live, pay, get food, that kind of stuff, to a negative of $1,100. This guy was about 38 years old. He contacted me. We restructured every single one of his loans to go back into a 30-year fixed. The week before he went in to sign on those 4 new loans, he had to pay for 4 new loans because of these dang HELOCs that he got. Those 4 new loans cost him that $5,000 to $7,000 per loan. He's spending a lot of money, but it was going to get him back to the $1,600 to $1,800 of clear capital to use every month. The week before he went in to sign, his man had a stroke. He's 38 years old. Now, his wife was with him when he had that stroke. She recognized that. She was in the medical field, got him to the hospital, got TPM on board. He was fine. He still had a little bit of a slur of speech. He slowed down a little bit, but from what I understand, he's a lot better now, way better now. But he went in and signed, and he contacted me later after he was feeling a lot better and thanked me for recognizing what needed to be done because he had no idea what to do there. So I'm just telling you guys, you can't control the HELOC. I of the mindset you can control what you can control, what you can control for as long as you can control it. I can control 30-year fixed. I can't control the HELOC. I don't know what's going to do. I don't know what the market's going to do. I do know for a fact it's going to go up. We have too many people saying it's go up. Anybody's claiming it's going to go down, it's got to come down. It's got to go up before it comes down. And we don't know where it's going to land at and stay at.
I like that. And I was just kind of, as you were talking, just rationalizing in my mind, just kind of doing the math. Like if we did the HELOC, like you said, if you have places, and Private Money Club offers that place to move money in and out, like this is definitely going to be more favorable, even at the rate of 8%, because you're still making a 4% spread if you lend it out at 12. And the other thing too is as this rate goes up, this is what a lot of people fail to realize. And we've seen it just because we've been lending for so long. You know, if your HELOC goes from 8 to 9 because rates go higher, you're going to start seeing deals on Private Money Club go from 12 to 15. We're already starting to see that. A lot of deals in Private Money Club, 15, 16, 17%. So really, it's just a mathematical equation because you're talking simple interest and simple interest. So it's just 12 minus 8 is 4, 15 minus 8, you start just doing the spread. And, you know, what a lot of smart people will do is, you know, they'll take the HELOC, put the HELOC in the IBC policy and then run it. So now over time, not in the first couple of years, but over time, they end up making a lot more money down the line because they make money twice, 2 spreads instead of 1. But over here, I can make the point too on the cash refi, the cash out refi, because even though you've got the upfront closing costs, which are there, even though you're giving most of the interest away in the first 5 years, or yeah, all interest almost in the first 5 years, if you got the same dollars out, and you earned 12% on that money, that's 12 grand. Same on both sides. But because you've got a fixed monthly expense, if you took this 12 grand and you took it and you basically used it all to pay down your mortgage, I'd have to believe before here, you would have no mortgage eventually because you're using somebody else's money to pay down your house, your mortgage. Where over here, I feel like this would take you longer to ever pay your house off. Now, I know you said don't ever, you know, focus on paying your house off, but like if somebody had that focus, I feel like this would be a better strategy. I just feel like they'd end up, more dollars would be going to paying off their house. I mean, we've all seen that, make an extra payment towards your mortgage or make, you know, bi-monthly payments towards your mortgage. It pays the mortgage down in half the time. But what nobody ever talks about when they're saying that, they're saying, oh, go work harder, make a little extra money, make an extra payment on your mortgage. I mean, come on, how many people actually do that and stick to that plan? Probably very few. But if you had the money from the cash out and you lent that money out or bought real estate and had rental, but I'm just going to keep it simple with lending because I like simple, and it made 12%, this is your money working for you. This is your lazy cash sitting in your house working for you at a rate of 12 or whatever percent you can get. And if you took all of that and just dumped it back down on your house, your mortgage, you still have the 100 grand to continuously keep doing that over and over and over again, because 100 grand never changes. You've got the cash out, but your costs are fixed. So therefore the 12 grand is paying down a huge amount of principal and you didn't have to work harder for that. Am I crazy in thinking that that actually makes a lot of sense?
Makes a lot of sense to me.
I mean, does anyone over here, you know, in the chat, we got, you know, 127 people now, but does that not make sense to somebody? If their goal was to pay off their house, but they still wanted to make money, like that seems to really make sense, does it not? But I'll let everybody kind of comment. Aaron, I want to get to some questions because we got 7 open questions here right now, and I'm sure there'll be more as we go. So I'm going to put us all on gallery here so we can see Steven's new camera, actually for the first time working now and focusing. So Kat came up, and this is an early question. Kat said, I want interest rates to go up so that real estate prices have a chance to stop flying up. I'd rather buy low. Is this logical to think that might happen?
So you're getting your wish, the rates are going up. So Kat, you definitely got that. I don't see them slowing down anytime real soon. When it comes to buying low, I don't know exactly when that's going to happen. The thing that we're talking about with respect to prices of housing, we're still under supply significantly. So you've got the supply of housing, the claims are anywhere from 1 to 5 million units short for what they really need out there for the demand that's there. So I don't know that we're going to have an extreme decline of housing. I think we might see a bit of a flat line. There's 100 different markets, the top 100 markets they track. The only one that had any sort of decline was Austin, Texas. Austin, Texas has been through the freaking roof for so long that it needed to come back a little bit. It's so dang overbought, but it didn't come back that much. It was still single digits. So it's a small decline in Austin from its peak. That's off of a peak. Right. So when you look at it from a historical standpoint, it's still up, and it's still up significantly. So I'm personally not one to say that would sit on the sidelines and wait for us to see some sort of massive decline. The other thing, if you're out there in the chatter of what's going on in the underground chatter of geopolitical crap, they're talking about another kind of a COVID shutdown, if you will. Look what happened last time we had something like that. Look what happened to supply chain. If that really happens again, that's only put prices of houses back up and continue to push them up, because people want to be away from others. They don't like this being inside multiple different houses. You've got people that are having to work from home again. They're sharing walls, and it turns out their neighbor now is a day drinker, and they're beating the kids. You can't really get outside the place. I mean, that's a whole other issue we got to deal with. So I don't know that we're going to start seeing prices decline a lot. I'm one that says you need to set your baselines, understand where you will be profitable in the scenario I talked about, having somebody else pay off the loan, and focus there. And when you find a deal, you take it. Don't wait for the deal to drop. It's one of these things where I equate that to being a star football player sitting on the bench waiting to get on the highlight reel. The people on the highlight reel already have their asses on the field, not the people watching. It says, as far as any other resource I have available, the best resource I can go is go to my website, aaronchapman.com, click on the media section, and you can see the videos. And I answer one of the questions with this. Click on that. It'll play one of the YouTube videos. Subscribe there. Twice a week, I give people information on what's happening in the market and how that affect you. Stay in communication with us, because as far as resources, the resources continue to change. What we try to do is just give you as much as we can at the time that we have it. And I'm coming out with another tool with respect to that quit jerking off investment tool. Something that's going to be even more extensive, and it's going to incorporate infinite banking into your real estate.
That's wild. And I just want to unpack a little bit of what you just said there, Aaron. A couple things. I mean, have you tracked, we hit this, and actually I saw it for pretty much the first time this morning on WTF. Have you looked at pharmaceutical stock prices lately? They've been very steeply declining. So it only makes sense. We should have another shutdown, because I mean, we can't have the pharmaceutical companies' stock prices dropping. And also, hey, let's not forget, when does all this political, debates all kick off and all this stuff? Pretty soon, right?
The next 60 days, we're going to start having all that happen. And so there's claims between September and October, we're going to start seeing them pushing on masking and shelter in place and all that kind of crap again, and pushing it into the next election. So it worked the first time, but I don't know it's going to work so well the second time, because I don't know if people are going to put up with that crap.
Yeah, they got to use the fear tactic to get control of people, so that they get people to vote the way they want. It's a sick freaking game. But I think by now, at least I hope by now, people are smart enough to see the game that's being played here and realize, nope, I'm not going to do it. We said it earlier. The only one that's going to change this whole thing is us, because they're going to keep playing that playbook. Because if it worked once, let's see if we can get it to work twice. And I don't know. Hopefully that's not the case.
People, I travel a lot. I still see a lot of people walking down the street by themselves with a mask on. So believe me, it's still going to work for a few.
I see there's this couple in my neighborhood who walk almost every day. And they're outside. It's a husband and wife, and they walk wearing masks. And there's nobody around them. I mean, I don't live in a densely populated area, so sometimes I hate to each their own. I mean, good for them if they think that's doing them good, but I simply can't understand the logic. Unless birds are carrying COVID, I don't know. You got a better chance of getting a bird dropping on the head than you do catching COVID walking out in the open street air with your spouse.
100%. So,
but what do I know? I don't know the science, but I don't think they do either. And the other thing too,
it's fear is what they're doing. It's all about fear and pressure.
Yeah, and I hate even talking about it, because it just makes me sick to my stomach. But getting to the price of real estate, and it's kind of like this demand thing. All we hear about is demand, demand, demand. But when you actually look at it, the demand largely is from people that can't afford the housing stock that's out there right now, which is why if you ever look at, like, if you talk to realtors, which you talk to a ton of them, but I've been talking to a lot lately, and I'm asking them, where are you seeing the most demand? And it's in the lower price point housing, like the first time home buyer houses. They're getting like 60 bids on a house, but that's because the houses are in that lower price point where first time home buyers can afford it. So the housing stock there is really low, but you got home builders building houses trying to make up for some of this, but home builders are definitely not feeding that first time home buyer price point. And, you know, once you start getting to the debt to income ratios, which I know have tightened up a little bit, you probably know more, like, how can the demand ever be satisfied at the current pricing? To me, it seems like a pipe dream. We can keep talking about demand is going to drive prices higher, but how high can we go when the baseline of the demand is people that can't afford higher price houses? So, you know, I always think something's got to give. Price has to give to the demand, because the demand can't afford the housing stock that is going to be coming online. I don't get it.
So what we have right now is, when you consider what they're trying to turn us into, is a subscription-based economy, right? Everything you get, you're paying for on a monthly basis. There is, you know, National Association of Home Builders not interested in more single family. They're interested in more apartments. They're interested in more townhomes, condos, that kind of thing, so they can condense more people into smaller areas. So that being the situation, like, take downtown Phoenix, for instance. I was just there. My dentist has got to open up an office downtown Phoenix. I can stand on the roof of his building with him. We were looking at all the projects going on out there. I think we counted 7 or 9 cranes, all building high-rise living structures, and not a single one is up for sale. Not a single one. They're all to be rented. We're being turned in that kind of into that type of a social structure. Even got to the point, remember BMW tried to sell the top end BMWs with all the bells and whistles, but for a mid-level price, because you had to pay a subscription for all the extras. If you wanted your seat heater to work, you had to pay for a subscription. You wanted your AC to work, you had to pay subscription. You wanted the cruise control to work, it was subscription basis. That didn't go over well, so that all blew up on us. But the reason I bring this up is because you're right that that the equilibrium should bring it down to affordability, but are we going to have that available to us to even buy? So there's going to be a scarcity, in my opinion. This is straight up Aaron Chapman opinion, with all the stuff that we're getting, a scarcity still on the single family is going to keep that cost up there. So if you hold single family assets, you want to hold them. You want to keep holding them. If you are thinking about real estate investing, it's like, now is a good time to do it as the price can go down. I'm saying get your hands on those assets. Let's get you qualified, get you moving forward on that, because I don't believe, one, we're going to see that decline. Two, you need to figure out your baselines. Work with us. We'll help you understand what they are and what they need to be for you. So when you see the deal, you grab it, because all that's happening is our entire social order is being built in a way to make a significant amount of people, your subscription-based people, take advantage of that and become one of the people offering the subscription, which is a house to live in and pay rent on.
Interesting. But yeah, I love what Kat said, you know, and I'm seeing that too. You know, I live in a neighborhood with pretty high priced homes, and when the house goes up, and there's been lots of them going on the market, the price drops on those houses have been they've been significant. So we watch them go up, you know, because they think, oh, we're going to get it, and they're getting no action. You just see the prices come down 100,000, 200,000. You know, these are expensive homes, but you're seeing it exactly what Kat's saying, in that upper echelon of homes. Like, you know, I don't know what it is. It's going to vary state by state, county by county, but you know, you're seeing those higher priced homes coming down in price, which is why I think probably largely why San Francisco, which must not be in that 100, you know, areas that thing tracks, because San Francisco is down high double digits in terms of pricing. But I think any market that has those lower prices, like Buffalo, for example, we have a lower priced home. Well, we used to anyway, but now those are coming up. I'd say our average homes now that are hitting the market are between 350 and 450. And to be honest, a lot of the new home buyers, they just can't afford that. So that's where they're moving to the rentals. So I kind of,
it's crazy that we're at 450. It blows me away. But the reason we're at 450, think about this. The reason we're at that average selling price, you know, Kat's bringing up right here, 420,000 on a 1,400 square foot freaking house. That was, my first house was bigger than that, and it was 110. Right, it was 1999. I bought that. Is because of the cost of money was so low. Those low interest rates. When you look at what they did there, there's a plan with all that. That right there pushed everything so freaking high because of that cheap rate capital. Now you can't get that cheap rate capital. It's keeping the cost of everything up, and it's forcing people to now become a subscription-based person. Our next generation can't afford that. They're okay with our generation affording it. The next generation, though, that's who they're targeting. And if we really want to get into the depth of, we can get straight up InfoWars about this shit if we wanted to, because it's a very, very patient thing when you consider all this, and it's all right in front of us, right? So we thought this was great. We got this really cheap money, but is at what cost? We see the cost of the cheap money. If you didn't take advantage of it, you didn't get what you're going to get, you didn't settle yourself into that. Now we're dealing with the aftermath. But plenty of us still have capital. We're all sitting right here, and now we're down to 124 people. They're sitting here that we literally have a bank sitting here in front of us that we can do these things on our own. It's now we got to figure out how to do it. That's going to take some time. It's going to take some energy. We'll probably have to sit down with a few people. You and I might have to go on the road a little bit and let's get this figured out. But I think we do have something that we can create. I got a guy in the back of my head right now we can talk to that will create a way of making sure we're all taking care of each other and create our own social structure and hell with these other some bitches.
Listen, you're speaking our language. I mean, between me and Steven, we talk about this all the time with Private Money Club. Like literally, like there's not a person on earth that can tell me that Private Money Club is not going to severely disrupt the entire traditional banking system, because that's the goal. Like you just said it, like just with the 120 some people we have here, we can start the effect of disruption. And then as that grows and you get thousands of people in Private Money Club, all doing that, not needing the banks, understanding how to mimic a bank, you do disrupt the entire industry, which is going to be wild to see if we can push that envelope. And folks, I'm sorry we went so deep down that rabbit hole about the demand and the pricing. I just, I hear it so much, and I'm just on the other side of the spectrum. I get the demand, I get the amount of people that want to buy, but at what price can they buy? That's the thing that we're missing. That's also assuming that we're going to stay at these low unemployment levels, that everybody's employed. The Fed knows why they can't get inflation to some fictitious 2%, and it's employment. They've been raising rates how many times? They've been unwinding the balance sheet. They're not getting what they want. Matter of fact, I saw an article somewhere that inflation is ticking up a little bit. Like they can't stop people from spending money because they're employed, which means when you're employed, I want all of you to, I don't have my wallet on me, but if you got a wallet, open it up. Like there's a little plastic thing in there called a credit card. That's how people are affording the lifestyles today. It's shown because we're at record levels, and everybody that has student loans is in for a wake-up call. In literally just over a month from now, those student loans are coming back online. That's an expense that most people haven't had in their household since 2020. And now all of a sudden, whatever, almost we'll call it 4 years later, because that's when the pain will be felt. Now all of a sudden that's real again. And everybody's at a max level. So how much more can Americans handle? And how many more lies do we have to be told by this administration? Like, hey, if you make under 400,000, your taxes aren't going to go up. Bullshit. Your taxes went up more than anybody else because of inflation, and inflation is a hidden tax. So don't believe the nonsense. You got taxed more than anybody because inflation is a hidden tax. Just look around. That's what it is.
Exactly. Now, one of the things you brought up there was credit cards and people living their cost of living structure and all that kind of stuff. Think about what they did when they turned us into a consumer society, right? We're not manufacturing anymore. We're not creating anything anymore. We're a strictly consumer-based economy in the United States. As a result of that consumer-based economy, we have now programmed people to feel that big urge. And think about it, everything we do is for a feeling. Everything. There's not a damn thing you do in your life that's not because you want to feel something. The reason a guy buys a Ferrari, so he can feel like he's better than the other guy who's competing for a female's attention. That's the only reason you drive a freaking Ferrari. Plus, I mean, they're damn cool, and it's expensive as shit. But we have turned ourselves into this thing. We're chasing a feeling. We're spending money. Because of that, we're over $1 trillion in credit card debt, the highest ever in history. We're starting to see this take effect, and they can't control inflation when people will not stop spending money. And because of that, we know that those of us that understand this thought process of what's going on here, we're using our money properly. Those are the people that are actually going to pay us money to use our money. Now, the thing about that is when you're creating your own banking world, right? We got to figure out how to do this in a way where we don't, I mean, there's this old, I think it was a Japanese philosopher said the tallest nail is the first to get hit. So how do you do that without being the tallest nail? The tallest nail that we saw in the banking world in the last 20 years was Angelo Mazzillo. I don't know if you guys recognize that name. Angelo, he just recently passed 85, I believe he's 85 or 87 years old. He was the guy who started Countrywide in 1969 in Hell's Kitchen. Countrywide Financial was the largest banking entity on the planet at the time of the crash. When the crash happened, they made Countrywide the sacrificial lamb. Countrywide did not create that crash. That was created a whole different way. The entire banking world was after Angelo because he single-handedly, with his team, created the largest financial institution on the planet, and the banks didn't like that. So they crushed Countrywide. It had $100 billion in assets at the time of its collapse, and Bank of America was able to purchase it for $4 billion. You don't tell me that that wasn't somebody being taken out to an auction and being strung up. I was with Countrywide at the time. I was sitting on a lot of the management calls and understanding what was going on, and we felt secure as all hell because we were the strongest in the entire industry, in the entire world, and it got taken apart. So that's one of those things you got to be we got to be careful how we go about it. There's a way to do it. There's a way to do this, and there's a way to make sure that we get this thing done right. We know enough people, Chris. We can make something like this work, I believe.
I listen, I totally agree. Let's get to Kat has a good question here. And sorry, we kind of got off the questions for a second, but that was an important rabbit hole to go down there. And hopefully you guys like that little dialogue there. But Kat says, Aaron, I really like what you said about the family trust you have where each of your family members are part of the voting and decision making. Could you share high level operation and this in a future show? So Kat's kind of asking, could you come back and almost just do another show kind of talking about how you've set that up? I think that would be very valuable. We teach the complex trust structures. It fits right into the infinite banking stuff. So is that something you'd be willing to come back on and talk about?
I'd love to come back, and I'd love to share exactly how we do that as a family. And the thought that I have here, now we're talking about this whole banking structure and be able to utilize the 100 and some odd people or however many people are part of this entire organization that you guys have got going on there.
About 5,500. So we got a lot more than 100.
So 5,500. With that, we need to really just sit down, and I have the people we can sit down and just really structure out the entire process from here's my capital going into the infinite banking strategy to the entire family process, the entire structure, all the legals, everything hands are literally you just acquire it, sign on the dotted line, have your lawyer endorse it and stamp it. You are now set up completely with operating systems, with your minutes and all that. So you can run your family business and start creating what we have here. Now mine is just in my head and how we just do it. We want to put it all on paper and make it a usable guide and a structure, and we can do that. So I don't see why we shouldn't just start getting really, really deep into the weeds on this.
Stephen, I think if you want to put that down, let's get a date for another wealth webinar where we literally map that out, whiteboard it all, and start the initial structures of what we're talking about there. Because with Private Money Club and with what we do with Money School, BYOB, and the Money Multiplier, I mean, you got 5,500 in Private Money Club. You got over 8,000 clients in IBC. There's some overlap, but I think we've got one heck of a good starting place. And if you've got a couple of the right people that can help us really move that mountain, then I've got
a technology company I'm heavily invested in that we can sit down and create the technology behind it. It'll cost a few bucks, but you can just borrow from the bank.
I love it. All right. And then we got Will said, so the money to put into escrow, this is back to where you were giving that example. I love this.
This is the BRRRR strategy, it sounds like.
Yeah. So the money you put into escrow reduces the loan amount. So effectively, that's your money to pull out immediately or as soon as you do the rehab and initiate the refi.
What that is the more money you put into escrow when you're closing on your BRRRR, right? You've got we'll go back over the example of $50,000 acquisition on the home that needs $20,000 of rehab or $25,000, and you take the entire $75,000 to closing. The title company will provide a closing on that, give the seller his $50,000 so he leaves and you now own the property. They keep the other 25 in what's called a repair escrow to pay your contractor that you've already gotten all the bids on, you know what's going to cost you, so we can show that you invested $75,000 at closing. I can do a refinance in the conventional lending world up to 75% of the value of that home, not to exceed the amount you invested at the closing table. So if you only took 50,000 at closing and you paid your contractor 25 grand, I can only get you 50,000. But if you brought the entire 75 and that settlement statement shows 75, and it has to be in a specific way, I have to guide you through that before you close, then I can literally finance that. You get all your money back out to put back into your policy or back to the bank here, however we want to do that. There's a different way we'll need to structure it. This can get very intricate. But then you get it all from bank capital, 30-year fixed. And as we've proven, you never even pay them back. The time value of money is on your side in that particular one. So you get your money back, put it back in there. You're literally using somebody else's money to take control of the property, using a tenant's money to pay that off. And everything you get is an infinite return because none of your money's in it any longer.
I love that. Hey, real quick, Aaron, before we get too much further, can you put all your contact information in the chat? And, when I get to Mac's question here, because I just remembered we're talking about all the stuff you can do to help people, and we keep forgetting to give them your info so they can contact you. All right. So as Aaron,
I'm putting my personal cell phone in there. You can just text me. And then what I will do is I will forward that text to my assistant, Bree, and she'll set up a call with us. The reason we do it that way is because I get calls. I've had 48 missed calls since our conversation. So she just sets up my life, and I live my life by a calendar. So first is my cell phone. I'll put that in there first. And then is my website, aaronchapman.com. If you cannot get into it, it should work. You'll take it to aaronbchapman.com. But for some reason, just Google me. There's only one bearded redneck lender out there like myself, named Aaron Chapman. So just Google Aaron Chapman. You'll find me there. Bree will set us up. I put the video library in there. If you scroll up, I put that in the chat. You click on the video library, click on any of those, and you can click on the, let me see here. I'll show you. I'll actually just put in the YouTube link.
Keep going with some of these questions. Max said, you mentioned about a booklet PDF, or is that actually what you're doing now? PDF on automobile buying? I'd like to know more. Oh, I know what you're talking about, Mac. That's my booklet. How to get all the money back for all the cars you ever buy, drive, and own. So if anyone wants the booklet we did, it's really good. It's literally step by step on how to buy automobiles and get all the money back. What you do is you just go to chrisnaugle.com and then just scroll down to Wealth Webinar, which is what you're in today, and you'll get that booklet. That's how you get it. And we have other ads out there, but that's the best way to do it.
So here's my YouTube. This is the most recent one. So you just click on that and subscribe. The other guy, if you search Aaron Chapman, you get a guy who's doing some gardening, which is a good.
When I searched it,
that would be a good thing to know, is how to garden, especially who knows what this world's going to come to.
Gardening definitely could be a thing. I for the first time, I planted a garden this summer. I mean, it was just berries and apples and pears, but now I got more apple. If any of you want apples, man, I got more apples than I know what the hell to do with. All right, so let's see. Let's keep going here. So Mac, I put that in there. Scott said, is there a calculator out there that shows what happens as money moves from an IBC policy to a HELOC and then back, and maybe accounts for maximizing your IBC up to your max? I can tell you right now, Aaron, if you got something that I don't know about, great, but I can tell you right now, there is not and never will be a calculator that could do that, because there's far too many moving parts that a calculator could never do. However, I don't know, who set your plans up, but if we set your plans up, our mapping team can actually do what you're asking them to right there. Once your policy's in force with us, that policy then goes to, to the mapping team, and they could show you scenarios doing exactly that. And I know Craig on our team could definitely do that as well. But a calculator that you can use, no freaking way. Aaron, you know of a calculator that can get that advanced?
That's pretty heavily detailed. You'd have to have somebody who is a spreadsheet nerd sit there and really go to work on stuff like that. But the other part of it is that thing is going to move on a minute by minute basis based on what's going on with your HELOC's balance, what your HELOC's interest rate is, and as you're paying it back and putting it, so you're literally going to be recalculating it all the time. So I don't know that there's anything out there. In fact, I am working on this calculator right now. I've actually got a meeting with the professor of accounting at Kennesaw State University. He heard me theorizing about the time value of money, and that's where my tool came from. He created a tool that I turned into an app for you guys to use for the time value of money. Now I have him building this massive system that we're going to make now something you could go online and subscribe to. And that right there, adding the infinite banking strategy to this on a docile basis is massive undertaking. I've got 2 or 3 different tech nerds really working their guts out on this. And I have no idea what my cost is going to be for this thing.
A lot. Somebody, Lauren just put up truthconcepts.com. We go to his site a lot. I've actually spoken on stages with him. He does not have a calculator that will do that. Contrary to all the calculators he's got on his site, you couldn't create a calculator that does that because, like what Aaron said, it would move on the minute. It would, literally every second, that would be a moving target. So you couldn't do it. But Truth Concepts does have some pretty decent calculators. But again, a lot of that, what he was asking for, requires manual entry of data from an insurance company's illustration first and foremost. Then you got the variabilities of the HELOC and the variabilities of where the money goes after the money goes into the IVC. So you've got tons of moving parts. It's a manual calculator. We actually just, I don't know if you guys can see this, but I'm going to make myself big because it's worthy of just showing you this real quick. And Stephen is going to put it in the chat. We have somebody on our team that created spreadsheets that do a lot like that. And he kind of looks like this guy here. And if you ask him what his job is, he says, my job, it's just spreadsheets. So you all know that that's Ken from, Ken and Barbie. There we go. So that's, that's Ken. We call him Craig Yenny, but that is his job. And I thought that was cute and a neat little thing to show you. So I'll unpin myself and we'll get to these other questions. All right, Cindy said, my husband wants to do this and I don't know how to explain it to him that it's not good right now. So Cindy was asking a question. I have to find it in the chat. She was basically saying, is now a good time to sell her house? Because her house is high. And Cindy, I'm trying to find your first chat. Basically, I'll try to just sell her house and then buy another house. And chat it in real quick, Cindy, if you can kind of do that. And I was saying, unless there's some important reason why you'd want to sell your house and buy another house right now, I couldn't understand why. I don't know.
That's all dependent on you individually. I don't know if you're looking for a specific investment situation. Let me explain to you one that did make sense to me. My mother, she lived here in Arizona. Her house was worth 1.1 million. She sold it, bought the exact same size house, actually a larger house on a larger lot in Branson, Missouri, overlooking a lake for half the price, and then pocketed the other half. And now she's, it's part of her retirement strategy. So she has more home, better location. I don't have to worry about her as much. She's not out here in this nasty heat in her 70s, and she's a much better situation. So in scenarios like that, I can see doing that. If you're saying, hey, I've got my house here and I'm just going to move down the street and see what I can do there, you're at risk of paying the same for less or paying more for the same or something to that effect. It may not get you where you're going to get. If it's for location, I don't see why you wouldn't want to do that. Location works out. And if you're in a place where people are demanding the house where you are, take it and go move to a location where you can do better. And guys, we're here to live. We're talking about life insurance. Let's think about this for a second. What we're talking about is some way to ensure that you have a better existence. The one thing I love about the infinite banking strategy and the fact that it's life insurance, it ensures that I can live the life to the extent that I want to, not sit here and worry about what am I going to leave my kids, right? If you want to move, you want to get to a different place, you want to sell your house and it makes financial sense to you, even if it's a little bit more, then you're in a better place. You're enjoying yourself and you're enjoying whatever life that you have left. Because let's just think about it, guys. None of us get out alive. When you're talking about life insurance, all these clients that I have, there's like, well, I'm trying to buy these houses, leave something to my kids. And they're living really meagerly, so you leave something for the kids. I'm like, hell with my kids. I'm going to spend my last damn dollar hunting when I die. That's my intent. Why? Because the death benefit's going to kick in and give them more freaking money than I ever had.
Bingo.
I don't have to worry about them. That's why I have death benefits coming out my ass. I am going to live and use every single cent that I can to exist the way I want to. Right now, I'm still in that building period. I don't know that I'll ever get to retirement. When I go to the grave, I'm coming in hot because I can't freaking stop. Now that we've had this conversation, I have more to do. So we got to build up this bank for everybody.
Let me give you an example of where selling your house right now would make sense. Stephen, where do you live in Florida?
Jupiter.
Jupiter. Your property values have gone up a lot in Jupiter, right?
Right a bit.
So Stephen could sell his house right now in Jupiter, make a really pretty penny, and then move his ass up to Buffalo, New York, in my neighborhood, which is a beautiful neighborhood. We could probably get him a house right on the lake, and he would basically have enough money to pay for that house. What do you say, Stephen?
No, thank you.
Doesn't make sense for him there, but financially, like that would, because he'd be able to move into a much bigger house right on a lake. But yeah, he doesn't like the cold, so that wouldn't work. Bad joke, Stephen. Bad joke. Just figured I'd explain where it could make sense financially.
Good try.
Good try. Good try. Well, Aaron, this has been awesome. I appreciate all the hard work you do, and I can't wait to get another one set up where we can start laying out the foundations on be your own bank on a large scale with the things that we've got. So I think that's the next step, and teaching people how they can create their own banking systems and their own family banking systems, like you've been mentioning the entire time.
Good. Thank you guys. Appreciate you taking the time, and I'm glad. Hopefully, this resonates, and there's more stuff to talk about in the near future.
Oh, I guarantee you there will be. So folks, thank you all for joining us for another week of Wealth Webinar. And we'll see a bunch of you this afternoon at 4:30 Eastern for Ask Me Anything, where you get to ask us any question you want. And you get the whole team there. So it's going to be a ton of fun. Just join us on YouTube. Just go to my YouTube channel at the Chris Naugle. Make sure you're subscribed and click the alerts button. It'll notify you right around 4:30 when we go live. Until then, see everybody on the next one. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.